3 weeks ago, on a Friday afternoon in mid-November, a document appeared in the Securities and Exchange Commission's filing system. Form 13F required disclosure for institutional investment managers with over $100 million in assets. 45 days after the end of each quarter, these filings hit the SEC database. Routine, boring, the kind of paperwork that gets skimmed by analysts and ignored by everyone else, except this particular 13F wasn't routine. This one showed that the Bill and Melinda Gates Foundation Trust sold 65% of its Microsoft holdings in a single quarter. 65%. Not a trim, not a rebalancing. A liquidation of 17 million shares worth $8.7 billion. Microsoft, the company Bill Gates founded in 1975. The company that made him one of the richest people on earth. The company he built from a garage to a $3 trillion empire. Gone. 2/3 of it. In 90 days. And here's what makes this even stranger. Buried in that same filing period, across dozens of other 13F forms submitted by billionaire-controlled trusts and family offices, a pattern emerged. A pattern so consistent, so coordinated, so utterly at odds with what these same billionaires are saying publicly that it can only mean one thing. They know something. Something big enough that $16 billion in combined insider stock sales during 2025 isn't precaution. It's preparation. Jeff Bezos sold $5.7 billion in Amazon stock. 25 million shares liquidated between June and July, the largest insider divestment of the year. Mark Zuckerberg dumped over $733 million in Meta shares in the first quarter alone, and he kept selling throughout the year. Jamie Dimon, CEO of JP Morgan Chase, sold stock in the bank he runs for the first time in 19 years, not once, multiple times, over $400 million worth since he announced his first sale in late 2023. Warren Buffett, the Oracle of Omaha himself, has been a net seller of stocks for 12 consecutive quarters. 12 quarters. 3 straight years of selling more than buying while the market hit all-time highs. His cash pile now sits at over $380 billion. More than Apple, Amazon, Alphabet, and Microsoft have in cash combined. And the most terrifying part? Nobody's talking about it. The financial media covers Bezos selling billions in Amazon shares, like it's wedding planning. They explain Zuckerberg's sales as routine diversification. They rationalized Dimon's first JP Morgan sale in 2 decades as estate planning. But when you add it up, when you see Bill Gates quietly shifting his foundation, his $36 billion portfolio out of tech and into trash collection companies, railroads, and Berkshire Hathaway's cash pile, when you watch Warren Buffett sell Apple stock for the 9th straight quarter while praising it as one of the best businesses in the world, when you track the insider buy-sell ratio falling to 0.27, the 3rd lowest level in 7 years, the message isn't subtle. It's screaming. The richest people on earth are exiting, and they're doing it right now, while you're being told everything is fine. While CNBC runs segments about economic resilience, while your financial advisor tells you to stay invested for the long term. The smart money is moving, quietly, methodically, with the kind of urgency that only makes sense if you know the ship is sinking. And today, I'm going to show you exactly what they're seeing, why $16 billion in insider sales is just the beginning, and why the assets they're buying instead of stocks should concern anyone who thinks their retirement account is safe. This isn't speculation. This isn't conspiracy theory. Every number I'm about to share comes from SEC filings, documents submitted to the federal government under penalty of perjury. The billionaires signed their names to these disclosures. They told us exactly what they're doing. The only question is whether you're paying attention. Let me start with the numbers, because the numbers don't lie, even when everyone with a microphone does. According to data compiled by Bloomberg from SEC filings, billionaire founders, CEOs, and directors took more than $16 billion off the table in 2025. That's verified. That's documented. That's not speculation or conspiracy theory. That's what they filed with the government under penalty of perjury. Now, $16 billion sounds abstract until you break it down by individual and realize these aren't random sales. These are concentrated exits by the people who built these companies. The people who know these businesses better than any analyst, any fund manager, any talking head on television. Let's start with Jeff Bezos. The Amazon founder and executive chairman sold 25 million shares of Amazon stock in 2025. Total proceeds, $5.7 billion. He started selling in late June, right around his wedding to Lauren Sanchez in Venice. By late July, he had completed the entire sale under a prearranged 10b5-1 trading plan he filed with the SEC back in March. Here's what makes this significant. Bezos still owns roughly 900 million Amazon shares. He remains the company's largest individual shareholder, with about 9% of the company. But since 2002, he has now sold more than $50 billion worth of Amazon stock, according to the Bloomberg Billionaires Index. The media frames these sales as funding for Blue Origin, his space company, or philanthropic efforts through the Bezos Earth Fund. And yes, he did donate stock worth $190 million to various nonprofits in 2025. But that's a fraction of what he sold. The real question isn't why he's selling. Billionaires sell stock for lots of reasons. The question is, why now, and why this much, when Amazon stock only gained about 5% in 2025, underperforming the S&P 500's 16% return? If you believed your company's stock was going higher, would you sell $5.7 billion worth while it's underperforming the market? Now let's look at Mark Zuckerberg. The Meta CEO sold over $733 million worth of company shares in the first quarter of 2025 alone. He sold through the Chan Zuckerberg Initiative and its related foundation, all under a 10b5-1 trading plan. The sales occurred in January and February when Meta's stock was trading above $600 per share. But he didn't stop there. Throughout the year, Zuckerberg continued selling in smaller batches, 12 million here, 14 million there. According to SEC filings, Meta insiders made over 1,000 transactions in a 6-month period. Of those transactions, exactly 0 were purchases. All 160 were sales. Let me repeat that. In 6 months, Meta insiders executed over 1,000 stock transactions. Every single one was a sale. Not one insider bought a single share. Zuckerberg has now sold over $2.2 billion worth of Meta stock since 2024. The company's market cap has grown to nearly $2 trillion. The stock hit an all-time high above $728 in February 2025. Analysts are bullish. Wall Street loves the AI investments, and the CEO is selling hundreds of millions every quarter. Then there's Jamie Dimon. The JP Morgan Chase CEO made history in February 2024 when he sold stock in the bank he runs for the first time since becoming CEO in 2005. Not the first time in a few years, the first time in 19 years. That initial sale was worth roughly $150 million. He sold 821,778 shares. In April 2024, he completed the plan by selling another 178,222 shares, worth about $33 million. The bank said the sales were for financial diversification and tax planning purposes. Fair enough, but Dimon wasn't done. In February 2025, he sold another 806,361 shares, worth approximately $234 million. Then in April 2025, another 133,639 shares, worth $31.5 million. By the time all the sales were complete, Dimon had liquidated over $400 million worth of JP Morgan stock. This is the man who has run JP Morgan for 2 decades, the man who has access to every piece of economic data the bank collects, the man who knows exactly what's in the loan books, the derivative positions, the commercial real estate exposure, the man who steered JP Morgan through the 2008 financial crisis while other banks collapsed. After 19 years of holding, he decided that 2024 and 2025 were the years to sell. That's not retirement planning, that's exit planning. Now let's zoom out and look at the broader insider selling picture. According to Guru Focus data, the insider buy-sell ratio for the overall U.S. market stood at 0.27 as of January 2026. That means for every insider purchase, there were roughly 3.7 insider sales. The historical median is 0.34. The long-term average is 0.42. We're significantly below both. For CEOs specifically, the ratio was 0.36 as of December 2025, still below the historical median of 0.34 for that group. Even the executives running these companies are selling more than buying. In August 2025, data showed that only 151 S&P 500 companies saw insider stock purchases in the previous month. That's the lowest number since at least 2018, according to Washington Service data. The insider buy-to-sell ratio fell to 0.26 that month, the third lowest reading in 7 years. Let me put this in perspective. Corporate insiders are the CEOs, CFOs, and board members who know their businesses better than anyone. They see the order books, they know the pipeline, they understand the competitive dynamics. They have access to information that won't be public for months. These people are supposed to be bullish on their own companies. They're supposed to believe in the businesses they run. But they're selling at near record rates. Meanwhile, retail investors, the people without inside information, are buying through 401k contributions, through index fund purchases, through automated paycheck deductions into target date funds. The smart money is selling what the less informed money is buying. This setup has preceded every major market correction in history. The dot-com bubble, the 2008 financial crisis, the 2022 bear market. In each case, insider selling spiked before the crash. In each case, the people who knew the most got out while the people who knew the least held on. And right now, the ratio of insider sells to insider buys is telling you something. The people running America's largest corporations are taking money off the table, not in small amounts, in billions of dollars, coordinated across industries. Accelerating through 2025, Dell Technologies. CEO Michael Dell sold over $2.2 billion worth of stock in 2025. Jensen Huang, CEO of NVIDIA, sold more than $1 billion in shares even as the stock rose 35%. Broadcom insiders sold over $100 million worth, including $42 million from CEO Hock Tan in a single transaction. The sales aren't uniform, they're targeted. And they're happening at the exact moment when valuations are stretched, when concentration risk is at historic levels, and when the economic data beneath the surface is starting to crack. These aren't random acts by unconnected individuals. This is a pattern. And the pattern is saying something very clear. Get out while you still can. Now let me show you what Bill Gates specifically is doing because his moves are the most telling of all. The Gates Foundation Trust portfolio, as disclosed in its third quarter 2025 13F filing with the SEC, was valued at $36.58 billion. That's down from over $48 billion earlier in the year. Where did the money go? It was liquidated, converted to cash, donated to fund the foundation's charitable operations. But here's what's important. The composition of what remains tells you everything about what Gates expects to happen next. Microsoft used to be the number one holding in the Gates Foundation Trust portfolio. For decades, the company Bill Gates co-founded in 1975 sat at the top of his foundation's investments. As recently as early 2025, Microsoft represented 28.6% of the portfolio. It was the cornerstone position, the anchor holding. Then came the third quarter filing. The trust revealed it had sold approximately 17 million shares of Microsoft. That's a reduction of nearly 65% in a single quarter. The position went from roughly $13.9 billion down to approximately $4.76 billion. Microsoft dropped from the number one holding to number 4. Let me say that again. Bill Gates, the man who founded Microsoft, the man whose name is synonymous with the company, the man who spent decades building it into one of the most valuable corporations on earth, just moved Microsoft from his foundation's largest holding to its 4th largest. The stock wasn't underperforming. Microsoft is one of the best run, most profitable tech companies in the world. Azure cloud revenue is growing. The AI partnership with OpenAI is generating billions. Copilot is being integrated across the entire product suite. Wall Street loves the company. And Bill Gates sold 65% of his foundation's position anyway. Why? Because even great companies aren't worth holding at elevated valuations when you expect the market to reprice. Now look at what replaced Microsoft at the top of the portfolio. Number 1, Berkshire Hathaway. Warren Buffett's conglomerate now sits at 29.91% of the Gates Foundation portfolio, valued at approximately $10.9 billion. Number 2, Waste Management. The trash collection company now represents 17.47% of the portfolio, worth roughly $6.4 billion. Number 3, Canadian National Railway. The railroad company accounts for 13.36%, approximately $4.9 billion. And then Microsoft, in 4th place at 13.01%. This is a complete restructuring of priorities. Gates didn't just trim Microsoft, he fundamentally reordered his entire investment thesis. Let me explain why those top 3 holdings matter. Berkshire Hathaway is Warren Buffett's conglomerate. It owns insurance companies, railroads, utilities, manufacturers, and a massive stock portfolio. But most importantly, Berkshire is sitting on over $380 billion in cash and treasury bills. Buying Berkshire is effectively buying a cash proxy with optionality. If the market crashes, Berkshire deploys that cash to buy assets at distressed prices. Buffett has done this repeatedly throughout his career. During the 2008 financial crisis, he invested $5 billion in Goldman Sachs, at terms that made him billions in profit. During the pandemic crash in March 2020, he waited patiently while others panicked. If inflation accelerates, Berkshire's tangible businesses generate pricing power. Insurance premiums rise, railroad rates increase, utility bills go up. The cash flows keep coming regardless of what the dollar does. If the economy enters recession, Berkshire's diversified revenue streams provide stability. People still need insurance, freight still moves by rail, electricity still flows. It's the ultimate defensive holding. And Gates is loading up on it. The trust also trimmed about 9.78% of its Berkshire position during the quarter, selling approximately $1.14 billion worth. But even after that trim, Berkshire moved from the 2nd position to the 1st. That tells you how dramatic the Microsoft reduction was. Now let's talk about Waste Management. This is a trash collection company. Boring. Unsexy. Nobody talks about waste management at cocktail parties. Nobody brags about owning garbage stocks. But here's what waste management actually is. An essential monopoly with pricing power. People produce garbage regardless of whether the economy is booming or crashing. In a recession, you still take out the trash. During a depression, the garbage trucks still run. This is non-discretionary spending at its most fundamental. Waste management has a near monopoly in many regions because the regulatory barriers to building new landfills are insurmountable. Environmental regulations make it nearly impossible for new competitors to enter the market. You can't just buy some trucks and start collecting garbage. You need permits, you need landfills, you need transfer stations, you need decades of regulatory approvals. No new competitor can realistically challenge waste management's position. The moat is made of government paperwork, and waste management generates steady cash flow with pricing power. When costs rise, they raise rates. When inflation hits, they pass it through. When the economy slows, trash volumes don't decline significantly. People don't stop producing garbage because the stock market is down. The company has a 1.4% dividend yield and produces approximately $371,500 in revenue per employee. It's one of the best-run companies in America. Wall Street analysts have rated it a hold, which in analyst speak means it's a stable, predictable compounder. Gates holds over 32 million shares worth approximately $6.4 billion. That's not a small position. That's a cornerstone allocation. Then there's Canadian National Railway, another boring, essential asset. Railroads move freight, coal, grain, oil, intermodal containers. As long as the economy functions at any level, railroads are needed. Canadian National operates the only transcontinental rail network in North America that connects three coasts, the Atlantic, the Pacific, and the Gulf of Mexico. It's irreplaceable infrastructure. You can't build a competing transcontinental railroad. The land rights don't exist. The regulatory approvals would take decades. The capital costs would be prohibitive. This is a literal monopoly on moving goods across an entire continent, and it generates predictable cash flow. CN's operating ratio, the key efficiency metric for railroads, is among the best in the industry. The company has pricing power because shippers have no alternative for many routes. It pays dividends. It buys back stock. It compounds steadily. Now step back and look at what Gates has done. He sold 65% of a high-growth technology company trading at premium valuations, and he replaced it with a conglomerate sitting on $380 billion in cash, a garbage monopoly with pricing power, and an irreplaceable railroad that moves freight regardless of economic conditions. These aren't growth stocks. These aren't AI plays. These aren't momentum trades. These are bunker assets, the kind of investments you hold when you expect turbulence, when you expect the glamorous stuff, the tech stocks, the high flyers, the AI darlings, to get obliterated. Gates is positioning for a world where dividends matter more than growth, where tangible assets matter more than intangible hype, where survival matters more than speculation. The foundation also completely exited positions in Crown Castle and United Parcel Service during the quarter. Crown Castle owns cell towers. UPS is a logistics company. Both are perfectly fine businesses, but they're not bunker assets. They're not recession-proof. They don't have the same defensive characteristics as trash collection and railroads. Gates kept what survives. He sold what doesn't. And he's not alone in this thinking. The foundation plans to increase its annual grant making to $9 billion by 2026. It has a long-term goal to spend down its entire endowment by 2045. That means it needs to generate reliable cash flows and preserve capital for the next 2 decades. You don't preserve capital by holding overvalued growth stocks. You preserve capital by owning essential infrastructure that generates cash regardless of market conditions. That's the message from the Gates Foundation's 13F filing. The man who built the technology industry's most valuable company is selling technology stocks and buying trash companies and railroads. If that doesn't tell you something about what he expects to happen next, I don't know what will. Now, let me show you what Warren Buffett has been doing, because Buffett's actions are even more extreme than Gates. Warren Buffett just retired as CEO of Berkshire Hathaway at the end of 2025, handing the reins to Greg Abel after 6 decades at the helm. But before he left, he sent the clearest warning signal of his entire career. He built the largest cash pile in Berkshire Hathaway's history. As of the third quarter of 2025, Berkshire Hathaway held between $348 and $380 billion in cash and treasury bills, depending on which reporting period you look at. Let me put that number in context. That's more cash than Apple, Amazon, Alphabet, and Microsoft have combined. That's more than the Federal Reserve holds in Treasury securities. That's enough to buy every single NFL team and every single NBA team and still have $34 billion left over. Berkshire Hathaway now holds approximately $360 billion in U.S. Treasury bills alone. That represents about 5% of the entire short-term Treasury market. One company owns 5% of all the short-term government debt in America. And here's the critical part. Buffett didn't accumulate this cash by accident. He built it deliberately by selling stocks for 12 consecutive quarters. 12 quarters, 3 full years. From the fourth quarter of 2022 through the third quarter of 2025, Berkshire Hathaway was a net seller of equities every single quarter. The last time Buffett was a net buyer of stocks was the third quarter of 2022. Since then, Berkshire's stock sales have outpaced its purchases by more than $183 billion. Let me repeat that number. Warren Buffett sold $183 billion more in stocks than he bought over the past 3 years, and he parked that money in Treasury bills earning 4 to 4.5% risk-free. This is the man who built his entire reputation on buying stocks, the man who preached buy and hold for 60 years, the man who famously said his favorite holding period is forever. That man stopped buying and started selling, at scale, for 3 straight years, and his largest sale was Apple. Apple was Warren Buffett's most profitable investment ever on an absolute dollar basis. He started buying shares around 2016 when the stock traded at roughly $25 on a split-adjusted basis. Over the years, he added to the position until Apple represented more than 50% of Berkshire's entire equity portfolio. At its peak, Berkshire's Apple stake was worth approximately $175 billion. Buffett called it probably the best business I know in the world. He praised CEO Tim Cook repeatedly, saying Cook had made Berkshire more money than Buffett himself ever had. Then he started selling. In the fourth quarter of 2023, Buffett trimmed the Apple position by 1.1%. In the first quarter of 2024, he sold 12.8%. In the second quarter of 2024, he sold a massive 49.3%, nearly half the remaining position. In the third quarter of 2024, another 25% gone. By the time the selling slowed, Buffett had reduced Berkshire's Apple stake by approximately 70% from its peak. The position went from over $175 billion to roughly $57 billion. In the third quarter of 2025, he sold another 20 million shares worth about $4 billion. The stake now represents around 20% of Berkshire's equity portfolio, down from over 50%. He still owns about 238 million shares. Apple remains Berkshire's largest single stock holding. But the direction is unmistakable. Buffett is systematically exiting his most successful investment. Why would he do this? Because valuation matters, even for wonderful businesses. Apple currently trades at a forward price-to-earnings ratio above 33. That's the third highest among the Magnificent Seven stocks. It's well above Buffett's preferred range of 5 to 15 times earnings. It's above the S&P 500 average. At 33 times forward earnings, Apple's stock price is pricing in perfection. Any disappointment, any revenue miss, any margin compression, and the stock gets hammered. And the upside is limited because so much future growth is already baked into the price. The downside is significant because there's no margin of safety. Buffett is selling while it's still expensive. He's not waiting to find out if the valuation is justified. And Apple isn't the only stock Buffett has been dumping. Bank of America was Berkshire's third largest holding. Buffett rescued the bank during the 2011 crisis with a $5 billion investment when the company was reeling from the aftermath of 2008. He eventually accumulated roughly 12% of Bank of America's shares outstanding. Then he started selling. In 2024, Buffett sold 41% of Berkshire's Bank of America stake. In the third quarter of 2025, he sold another 26.3 million shares. The position keeps shrinking quarter after quarter. Bank of America trades at a price-to-book ratio of about 1.4, which is elevated for a bank stock. Buffett apparently thinks the risk-reward no longer favors holding. He also sold positions in companies like Chevron, DaVita, D.R. Horton, and Nucor during 2025. In the first 9 months of the year alone, Buffett sold over $24 billion worth of stocks. And what did he do with the proceeds? He didn't redeploy into other stocks. He didn't make acquisitions. He didn't buy back massive amounts of Berkshire shares. He parked the money in Treasury bills. Those T-bills are yielding Berkshire approximately $12 billion per year in risk-free income guaranteed by the U.S. government. That's not a bad return for doing nothing. But it's far below the historical stock market return of 10% annually. It's far below Buffett's own lifetime average of roughly 20% per year. Buffett is accepting lower returns in exchange for safety and optionality. At Berkshire's annual shareholder meeting in 2025, Buffett was blunt about what scared him most. He said runaway fiscal policy is his biggest concern about the U.S. economy. He warned that as the government continues to borrow and spend, it may eventually be forced to print money to cover its debts. That would devalue the currency and erode the purchasing power of every American. He also talked about the stock market using a metaphor of a cathedral with a casino attached. The cathedral is where real business growth and value creation happen over decades. The casino is where people speculate on short-term price movements. Buffett's message was clear. He sees too much action in the casino and not enough value in the cathedral. When asked why he wasn't deploying Berkshire's cash, Buffett said he doesn't see many opportunities in the market right now. Everything is overvalued. Stocks are expensive. Private equity is expensive. Acquisitions are too pricey. So he's waiting. And while he waits, he's selling, raising cash, building ammunition for the moment when fear replaces greed and assets get cheap again. This is the Buffett playbook. He's executed it throughout his entire career. Sell high, hold cash, wait for the panic, buy low. In 1969, he liquidated his investment partnership because he couldn't find bargains. In 1974, during the worst bear market since the Depression, he went shopping and loaded up on cheap stocks. In 1999, he was mocked for avoiding technology stocks during the dot-com bubble. A year later, those stocks crashed 80%, and Buffett looked like a genius. In 2008, when everyone was panicking, Buffett deployed billions into Goldman Sachs, General Electric, and other companies at distressed prices. He made a fortune while others were paralyzed by fear. Now he's sitting on $380 billion in cash, waiting, patient, ready. If the market drops 30 or 40%, Berkshire has the firepower to buy entire companies at pennies on the dollar. They can acquire distressed assets that other investors are forced to sell. They can be the buyer of last resort when everyone else is selling. That's not bullish positioning. That's not confidence in the market. That's preparation for a crash. Preparation for a crash. And Buffett left one more signal before he retired. For 5 consecutive quarters, Berkshire Hathaway didn't buy back any of its own stock. 0 share repurchases. This, despite Berkshire shares underperforming the S&P 500. This despite Buffett repeatedly saying stock buybacks are a great use of capital when shares are undervalued. If Buffett thought Berkshire stock was cheap, he would be buying it hand over fist. He's not. He's letting the cash pile grow instead. That tells you he thinks even Berkshire's stock, a company he knows better than anyone on earth, isn't cheap enough to buy at current prices. The Oracle of Omaha spent 60 years telling investors to buy quality companies and hold them forever. Now he's selling his best investments and hoarding cash. Listen to what he's doing, not what the financial media says about it. Now let me connect the dots between what the billionaires are doing and what they're seeing in the data. Because individual insider sales don't happen in a vacuum. They happen against a backdrop of market conditions that smart money can read like a roadmap. And right now, that roadmap is flashing warning signs everywhere. Start with valuations. The S&P 500 price-to-earnings ratio currently sits at 27.59 as of late January 2026. That's not a typo. Nearly 28 times earnings for the broad market index. To understand why that matters, you need context. The 20-year average P/E ratio for the S&P 500 is 16.31. The current level is roughly 70% above that long-term average. Using statistical terms, we're 2.3 standard deviations above the modern era average. In plain English, the market is priced at levels it has almost never sustained in history, according to analysis from Current Market Valuation. COM, the S&P 500 P/E ratio is 90% above its historical norms. The rating system classifies this as strongly overvalued. Not slightly elevated, not moderately expensive, strongly overvalued. The forward P/E ratio, which uses projected future earnings instead of trailing earnings, sits around 23.7. That's better than the trailing number, but still well above the 5-year average of roughly 20 and the 10-year average of approximately 18.7. According to FactSet Research, the S&P 500 has only sustained a forward P/E ratio above 22 during 2 periods in the last 40 years. The first was the dot-com bubble from 1998 to 2000. The second was the COVID pandemic stimulus bubble from 2020 to 2021. Both times, the market crashed. The dot-com bubble popped in March 2000. The S&P 500 fell 49% from peak to trough. The Nasdaq collapsed nearly 80%. Trillions of dollars in wealth evaporated. Companies that were valued at billions went to zero. The COVID bubble deflated in 2022. The S&P 500 fell 25%. The Nasdaq dropped over 33%. Growth stocks got obliterated. Speculative assets collapsed. Right now, we're back above 22 times forward earnings. And the billionaires are selling. That's not a coincidence. That's pattern recognition from people who have seen this movie before. But the P/E ratio only tells part of the story. Let's look at the Shiller-Cape ratio, also known as the PE10. The Cape ratio was developed by Nobel laureate Robert Shiller. It takes the current price of the S&P 500 and divides it by the average inflation-adjusted earnings over the past 10 years. This smooths out short-term fluctuations and gives you a longer-term view of valuation. As of December 2025, the Cape ratio sits at levels that place it in the 99th percentile of its historical range. Let me repeat that. The market's valuation is higher than it has been 99% of the time throughout recorded history. The only period when valuations were higher was December 1999, right before the dot-com crash. The Cape ratio hit 44.2 that month. Within 3 years, the market had lost half its value. The average Cape ratio throughout history is 17.7. We're currently more than double that level. According to Advisor Perspectives analysis, the PE10 is in the highest quintile, suggesting a highly overvalued market. Their historical research shows that when the Cape has fallen from the top quintile, it has often continued its decline into the lowest quintile. To reach a single-digit Cape ratio from current levels would require the S&P 500 to fall below 1715. That's a decline of over 70% from current prices. Now, I'm not predicting a 70% crash, but I am showing you that valuations have massive room to compress. The market could fall 30, 40, even 50%, and still not be at historically cheap levels. This is the backdrop against which billionaires are selling. They're not selling because they need the money. They're selling because the risk-reward equation has shifted dramatically against holding stocks at these prices. Let me give you another way to visualize this. Goldman Sachs strategists have noted that the S&P 500's current valuation starting point suggests limited upside and elevated downside risk. When forward PE ratios are this high, subsequent returns over the next 1 to 3 years have historically been below average. The math is simple. If you buy something at 24 times earnings and it reverts to the historical average of 18 times earnings, you lose 25% of your investment even if the underlying company's profits stay flat. Valuation compression alone can destroy your returns, and if earnings actually decline during a recession, the losses compound. In a typical recession, corporate earnings fall 20 to 30%. If earnings drop 25% and the PE ratio compresses from 24 to 16 times those reduced earnings, you're looking at a 50% decline in stock prices. This is what the billionaires see when they look at the market. They're not just reading headlines about AI and economic resilience. They're doing the math on what happens when valuations normalize. Now let's talk about where the market has been versus where it's going. Wall Street strategists have their 2026 targets out. Oppenheimer predicts the S&P 500 will hit 8,100 by year end. These targets assume continued earnings growth, stable profit margins, and no recession. They assume the good times keep rolling. But what if they're wrong? Analysts' consensus estimates have consistently missed major turning points. In early 2000, the consensus was bullish right before the dot-com crash. In 2007, most strategists predicted continued gains right before the financial crisis. In late 2021, few predicted the 2022 bear market. Wall Street gets paid to be bullish. Negative predictions don't generate trading commissions. Bearish outlooks don't win investment banking mandates. The incentive structure pushes analysts toward optimism. The billionaires don't have that conflict of interest. They're playing with their own money, and their money is heading for the exits. Here's another valuation metric that should concern you. According to research from Columbia Threadneedle, the top 10 stocks in the S&P 500 now account for approximately 39% of the index's total market capitalization. That's well above the 27% peak reached during the technology bubble of 1999-2000. The market is more concentrated at the top than it was before the dot-com crash. During the dot-com era, those top 10 stocks traded at a price-to-earnings ratio of 43 times, while the rest of the market traded at 21 times. That's a premium of more than 100% for the largest names. Today, the top 10 trade at roughly 31 times earnings compared to 21 times for the rest of the S&P 500. The premium is smaller than in 2000, but the concentration is higher. When concentration is this extreme, the index becomes a leveraged bet on a handful of companies. If those companies stumble, the entire index gets dragged down. Diversification within the index is an illusion. And here's what makes concentration dangerous during a sell-off. Index funds have to sell their largest holdings first to raise cash. When investors redeem from S&P 500 index funds, the fund managers must sell Apple, Microsoft, Nvidia, and the other mega caps in proportion to their weighting. That selling pressure pushes prices down, which triggers more redemptions, which forces more selling. It becomes a liquidation cascade. The same passive flows that push these stocks up on the way in will crush them on the way out. The billionaires understand this dynamic. They're reducing exposure to the concentrated positions before the cascade begins. One more data point on valuations. According to Morningstar analysis, the top 10 U.S. stocks now account for roughly 35% of the overall market, up from just 18% a decade ago. Such narrow market leadership creates vulnerability. If any of these leaders stumble, whether due to earnings misses, regulatory changes, or other shocks, broad index performance can quickly reset. We saw this in 2022. When the Magnificent Seven stocks fell, they dragged down the entire S&P 500. The index declined about 20%. The Magnificent Seven fell over 41%. The stocks that led on the way up led on the way down. And today, those same stocks represent an even larger share of the index than they did in 2022. This is what elevated valuations combined with extreme concentration look like. It's a market structure that amplifies both gains and losses. When it works spectacularly. When it breaks catastrophically. The billionaires are betting it's about to break. Now, let me show you something that should keep every index fund investor awake at night. The Magnificent Seven stocks, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, now represent between 34 and 37% of the entire S&P 500 index, depending on which day you check. Let that sink in. 7 companies out of 500 control more than a third of the index's value. In 2015, these same 7 companies represented just 12% of the S&P 500. In 10 years, their weighting has nearly tripled. According to data from August 2025, the Magnificent Seven climbed to a record 34.5% of the S&P 500, or its total market value. By October 2025, that number had pushed toward 37%. That's roughly 3 times their weighting from a decade ago. This level of concentration is unprecedented in modern market history. According to research from Goldman Sachs, the top 10 stocks in the S&P 500 now account for approximately 39% of the index's total market capitalization. That's significantly higher than the 27% peak reached during the technology bubble of 1999-2000. Read that again. The market is more top-heavy today than it was at the peak of the dot-com bubble, the bubble that preceded a 49% crash in the S&P 500 and an 80% collapse in the Nasdaq. Why does concentration matter? Because when you buy an S&P 500 index fund, you're not really buying 500 companies. You're making a massive leveraged bet on 7 technology giants. Think about what this means for your retirement account. If you have money in a total market index fund, a target date retirement fund, or any investment vehicle that tracks the S&P 500, more than a third of your money is riding on the performance of 7 stocks. Your diversification is an illusion. The S&P 500 is supposed to represent the broad American economy. Manufacturing, healthcare, financials, energy, consumer goods. Instead, it's become a concentrated technology fund with some other stuff sprinkled around the edges. Let me show you how this concentration played out in 2025. According to Capital Group analysis, approximately 42% of the S&P 500's total return in 2025 came from the Magnificent Seven alone. 7 stocks drove nearly half the index's gains. The average return for the Magnificent Seven in 2025 was around 27.5%. The S&P 500 returned approximately 16%. If you strip out the Magnificent Seven, the other 493 stocks in the index performed significantly worse. In other words, the headline returns masked what was actually happening beneath the surface. And even within the Magnificent Seven, performance was wildly uneven. Alphabet led the pack with returns of approximately 66%, driven by its AI chip developments and cloud business. NVIDIA followed with roughly 41% returns, though that was far below its 171% gain in 2024. Tesla returned about 20%. Meta gained around 13%. But Amazon only returned approximately 6%. Apple posted just 8.8%. Microsoft lagged the group as well. The dispersion within the Magnificent Seven is increasing. They're no longer moving in lockstep. The correlation among these stocks has dropped from 80% to roughly 20% since June 2025. This matters because when the leaders start diverging, it often signals a rotation is coming. The stocks that drove the market higher are no longer working together. Now let me show you why concentration creates catastrophic downside risk. In 2022, the S&P 500 fell approximately 20%, painful but manageable for a bear market. The Magnificent Seven fell 41%. That's more than double the index decline. The same concentration that amplified gains in 2020 and 2021 amplified losses in 2022. And here's the problem. When the Magnificent Seven fall, they drag the entire index down with them because of their massive weighting. Even if the other 493 stocks are stable, a 40% decline in 7 companies representing 35% of the index will crush your returns. The math is simple. If 7 stocks make up 35% of the index and they fall 40%, that alone knocks 14 percentage points off the index's return. The other 493 stocks would need to rise substantially just to keep the index flat. This is concentration risk in action. Your diversified index fund isn't actually diversified. Let me give you some historical context on why this matters. According to First Trust analysis, in 2023, only 27% of stocks in the S&P 500 outperformed the index's average return. That was the narrowest market since at least 1995. In 2024, just 28% of stocks beat the index, the second narrowest year in nearly 3 decades. This extreme concentration hadn't been seen since 1998 and 1999, right before the dot-com crash. Through the first 3 quarters of 2025, about 37% of S&P 500 members outperformed the overall index. That's better than the previous 2 years, but still historically narrow. When leadership is this concentrated, markets become fragile. The entire structure depends on a handful of stocks continuing to perform. If any of them stumble, if any of them miss earnings, if any of them face regulatory pressure, if any of them simply stop growing as fast, the whole index suffers. Now, let me show you how advisors and professional investors are responding. According to Investment News reporting, financial advisors are becoming increasingly concerned about concentration risk. Anshul Sharma, Chief Investment Officer at Savvy Wealth, says he is mindful of concentration risk as the Magnificent Seven continue to dominate returns. His approach is to deliberately right-size exposure so participation in secular growth does not come with unintended portfolio risk. Translation: even the professionals are trimming their positions. Brian Story, Senior Vice President at Brinker Capital Investments, says he expects the Magnificent Seven can continue to deliver solid returns in 2026, but believes they will be relatively in line with broader U.S. large-cap stocks. Because of greater concentration and diminished relative return expectations, his firm expects to modestly decrease allocation to Magnificent Seven stocks while increasing allocation to small caps, international equities, and real assets. The institutional money is rotating away from the most concentrated positions. Consider what happened to the hierarchy within the Magnificent Seven over the past year. NVIDIA surged to become the largest company in the group, passing Apple and Microsoft at various points. The chipmaker added nearly $4.4 trillion to its market cap since 2015. It went from being the smallest contributor to the Magnificent Seven at just 0.8% of the group's combined value to the largest at over 21%. Apple, which spent much of the last decade as the largest company by market cap, dropped to second place. Alphabet fell from second to fourth before bouncing back to third. Microsoft dropped from third to fourth. The leadership is churning even within the concentrated group. And there's another company knocking on the door. Broadcom is now larger than Tesla by market capitalization. If Broadcom replaced Tesla in the Magnificent Seven calculation, the group D's contribution to the S&P $500's year-to-date return through September would increase from 41.8% to 55.5%. The concentration is actually understated by focusing only on the traditional Magnificent Seven names. Now let me explain why passive investing amplifies these risks. When money flows into index funds, it gets allocated based on market cap weighting. $1 invested in an S&P 500 index fund puts 35 cents into the Magnificent Seven stocks. That buying pressure pushes their prices higher, which increases their weighting, which means the next dollar invested allocates even more to those stocks. It's a self-reinforcing cycle on the way up, but the same mechanism works in reverse on the way down. When investors redeem from index funds, the fund managers must sell stocks in proportion to their weighting. The Magnificent Seven get sold first and heaviest because they're the largest positions. That selling pressure pushes prices down, which triggers more fear, which causes more redemptions, which forces more selling. The passive flows that created the concentration will amplify the destruction when the trend reverses. This is why the billionaires are reducing exposure to these names. They understand the market structure. They understand the passive flow dynamics. They understand that concentration creates fragility. According to Morningstar analysis, when a handful of stocks do most of the heavy lifting, portfolios tied to broad benchmarks become less diversified than they appear. They create exposure to only a few business models, sectors, and factor profiles, which quietly dominate overall risk. Your S&P 500 index fund is secretly a concentrated technology bet. The billionaires know this. The institutions know this. The advisors know this. Now you know it too. Now let me show you what's happening beneath the surface of the economy. Because while the stock market hits all-time highs, American consumers are cracking. According to the Federal Reserve Bank of New York, total household debt reached a record $18.59 trillion in the third quarter of 2025. That's up $197 billion from the previous quarter. Credit card debt alone hit $1.23 trillion, the highest level ever recorded since the New York Fed began tracking in 1999. That's up $463 billion from the pandemic low in early 2021. A 60% increase in 4 years, and Americans aren't paying it back. Aggregate delinquency rates remain elevated at 4.5% of outstanding debt in some stage of delinquency. In the lowest income zip codes, serious delinquency rates on credit cards have pushed above 20%. Let me repeat that. $1 in $5 owed by consumers in the poorest neighborhoods is seriously delinquent. Credit card APRs are running between 22 and 24%. That's not a typo. People are borrowing at loan shark rates just to cover basic expenses. The Federal Reserve noted that transitions into serious delinquency, defined as 90 or more days past due, have been increasing across debt types. Credit card delinquencies rose for 11 consecutive quarters before recently stabilizing. Auto loan delinquencies remain elevated. Fed Chair Jerome Powell acknowledged at a recent press conference that there's a bifurcated economy. Consumers at the lower end are struggling and buying less and shifting to lower cost products. But at the top, people are doing fine. The headline economic data looks resilient because wealthy Americans keep spending. But the bottom half of the country is drowning in debt they can't repay. This matters because 70% of the U.S. economy is consumer spending. If that drops, GDP drops. Corporate revenues drop, earnings drop, stock prices follow. The billionaires see the consumer weakening, They see savings rates at historic lows. They see household debt at record highs. They see delinquencies rising. They're getting out before the consumer breaks completely. Now let me show you the elephant in the room that nobody wants to talk about: the AI spending bubble. Big tech is pouring money into artificial intelligence infrastructure at a pace that defies comprehension. According to Goldman Sachs, hyperscaler capital expenditure is expected to exceed $500 billion in 2026. Bank of America now sees global hyperscale spending rising 67% in 2025 and another 31% in 2026, with total outlays climbing to $601 billion. Amazon is leading the charge with $125 billion in capex for 2025, up 51% year over year. That represents more than 88% of the company's projected operating cash flow. Microsoft is spending over $80 billion. Google raised its 2025 capital budget to $92 billion. Meta expects spending of about $100 billion in 2026, up from $72 billion in 2025. These companies have collectively issued roughly $121 billion in new debt in 2025 alone, with over $90 billion raised in just 3 months. They're borrowing money to fund AI infrastructure because the spending now exceeds their cash flows. Morgan Stanley and JP Morgan project the technology sector may need to issue as much as $1.5 trillion in new debt over the next few years to finance AI and data center construction. Here's the problem: the revenue from AI products doesn't yet justify the capital expenditure. Meta is spending $72 billion in capex with no direct AI revenue reported. Microsoft has AI revenue of $13 billion annually, but is spending $80 billion on infrastructure. The gap between spending and monetization is enormous. AI data center facilities coming online in 2025 face $40 billion in annual depreciation costs, while generating only $15 to $20 billion in revenue at current usage rates. That math doesn't work. The billionaires aren't waiting to find out if AI investments pay off. They're selling while the hype keeps valuations elevated. Because if AI turns out to be overhyped, if the returns don't materialize, the stocks that led the market higher will be the ones that fall the hardest. Now, let me crystallize what all this insider selling actually tells us. The insider buy-sell ratio for the overall U.S. market stood at 0.27 as of January 2026. The historical median is 0.34. The long-term average is 0.42. We're significantly below both. For every insider purchase, there are roughly 3.7 insider sales. In August 2025, only 151 S&P 500 companies saw insider stock purchases. That's the lowest number since at least 2018. Corporate insiders are dumping shares while the market hits all-time highs. The heavy selling came from across the board. Dell Technologies insiders sold over $2.2 billion. NVIDIA's Jensen Huang sold more than $1 billion. Broadcom executives sold over $100 million. Meta insiders executed over 1,000 transactions in 6 months. Every single one was a sale. Academic research consistently shows that insiders tend to buy when their companies are undervalued and sell when shares are overpriced. They have access to information outsiders don't see for months. These people are supposed to be bullish on their own companies. Instead, they're selling at the fastest pace in years. The pattern has preceded every major market correction in history. Dot-com bubble, financial crisis, 2022 bear market, insider selling spiked before each crash. The signal's flashing red. So what are the billionaires buying while they sell stocks? Warren Buffett is hoarding $380 billion in treasury bills yielding 4 to 4.5% risk-free. He owns more treasuries than the Federal Reserve. Bill Gates shifted his foundation into Berkshire Hathaway, Waste Management, and Canadian National Railway. Boring assets that generate cash regardless of economic conditions, trash collection that people need during recessions, railroads that move freight no matter what. These aren't growth stocks. These aren't AI plays. These are bunker assets. The pattern is clear: cash and treasury bills for optionality, essential infrastructure for steady income, monopoly businesses with pricing power. The billionaires are positioning for a world where survival matters more than speculation, where dividends matter more than growth, where tangible assets matter more than hype. They're buying what survives crashes and selling what doesn't. So, when does this play out? Based on the patterns, here's a plausible timeline. Phase 1 is now. January through March 2026. Insider selling continues. Retail investors keep buying through 401k contributions. The S&P 500 stays near all-time highs. Volatility is low. Complacency is high. The financial media reassures everyone that the economy is resilient. Phase 2 hits mid-year. A major company misses earnings badly. The market pulls back 10%. Volatility spikes. The media calls it a healthy correction. Phase 3 accelerates in the second half. The correction becomes a crash. The S&P 500 drops 20 to 30% from peak. Recession gets declared. Layoffs accelerate. Phase 4 arrives in late 2026 or 2027, the bottom. panic selling, forced liquidation. And that's when the billionaires deploy their cash. Buffett's $380 billion goes to work buying assets at 50 cents on the dollar. The wealth transfers from the unprepared to the prepared. So what should you do with this information? First, assess your exposure. If you're heavily invested in S&P 500 index funds, you're concentrated in exactly what the billionaires are selling. Consider reducing that exposure to a level where a 30% decline doesn't destroy your financial plan. Second, raise cash. Not because you're timing the market, but because cash is optionality. When assets go on sale, you want buying power. Buffett's sitting on $380 billion for a reason. Third, shift toward defensive sectors, utilities, consumer staples, healthcare, waste management, railroads, boring stuff that generates cash flow and pays dividends. Fourth, avoid leverage. If you're using margin or trading options, you're setting yourself up to get wiped out when volatility spikes. Fifth, own physical assets, treasury bills, dividend-paying stocks, things that hold value when paper assets collapse. The billionaires are preparing. You should too. Let me bring this full circle. Bill Gates sold 65% of his Microsoft holdings. Warren Buffett has been a net seller for 12 consecutive quarters. Bezos dumped $5.7 billion in Amazon. Zuckerberg sold over $733 million in Meta. Diamond sold JP Morgan for the first time in 19 years. These aren't random acts. This is coordinated flight from risk. Every number I shared comes from SEC filings, documents submitted under penalty of perjury. The billionaires signed their names to these disclosures. They told us exactly what they're doing. The financial media will tell you to stay invested. Your advisor will say, stay the course. The talking heads will claim this time is different. But the billionaires, the ones with billions on the line, the ones with access to information you don't have, are selling stocks, holding cash, and buying defensive assets. They're preparing for a crash. The warning is here. The only question is whether you're listening.